Good afternoon, everybody, and welcome to today's Success webinar. I'm Tom Drost, President of Logical Engine, the creators of EstimateRocket and JobRocket. EstimateRocket is cloud-based mobile and desktop software that enables service contractors to manage their projects from lead to paid, generate professional estimates on site, and create proposals, work orders, and invoices with a click. It also includes scheduling, automated emailing, contract e-signing, and credit card payments. Great package. Hopefully most of the attendees know about it, and new ones will learn about it. Today's topic is how mergers and acquisitions can help you grow your consulting business. We're lucky to have with us today as a guest speaker Paul Delfino. Over 25 years, Opportunity Inc., Paul's company, has been focused on assisting small businesses through the various phases of financial growth and hurdles. And today, as I said, Paul is one of the two partners in the firm. Paul has a unique view and model for consulting. He crisscrosses the country every week, working very closely with clients from multiple industries. When I speak with Paul once a week, I never know where he's going to be, which state, and exactly where he's calling from. He's a sought-after speaker at industry association meetings and also does presentations for Inc. magazine. His articles are publications, and he has, over his career, has been on boards of publicly held companies, managed billion-dollar operating divisions of several financial institutions in New York and Boston, and he's run small, medium, and large companies. Paul knows this subject like the back of his hand, and in 1 second, I'm going to turn it over to Paul. We go through the presentation today, please feel free to type in your questions in the question box, and we'll certainly take those at the end of the presentation. And with that said, I turn it over to Paul. Paul?
Okay, thanks, Tom. Welcome, everybody. I hope everybody's having a great day. In case you're wondering what's behind me, that is a train set. I am an avid model railroader, and because of space limitations like we all have in the hobby, I built another railroad behind me in my office, which gives me the opportunity to turn around and play when I get frustrated. Today's presentation is going to be done in sort of a machine gun format. I'm going to pound you with a lot of information, and then hopefully we'll hone in on your specific questions in the Q&A at the end. At the outset, the objectives is to talk today about how deals get done, and potentially get you thinking about how you can be prepared for it. A small warning, having done many deals, having participated in many deals, and having consulted on the subject, small business people generally aspire to use M&A as a growth strategy, and most entrepreneurs have a dream and a vision of someday selling out. However, most of them don't have resources that have historically participated in the process. So today's hopefully going to give you another idea, and that is how to build a team to get ready for it. Some good news. 41% of the companies that want to sell do, and they generally get the numbers they want. About 55% of the fastest growing companies, that is small business and large, are involved in some kind of deal right now, in either an alliance and or an merger activity. And very, very important is that firms that are involved in alliances generally have a higher revenue and a better growth rate. For today's conversation, an alliance could be nothing more than a revenue share agreement that you have with somebody who is synergistic with your business, who can reciprocate with referrals to your business for new prospects. Now the bad news. 78% of the mergers and acquisitions fall apart within 3 years. We'll talk about why in a minute. 55% of alliances fall apart within 3 years. And 23% of the firms never recover the costs after they begin the corporate merger process. Mergers and acquisitions and this kind of activity is extremely expensive. And additionally, it is incredibly distracting, as I'm going to be showing you in a few minutes. If you remember anything today, it's a minefield. It's not something that you dabble in unless you have a strategy that's telling you specifically why you're trying to do this. It's not something you've done for fun or just for giggles or for a test or just for education. And you need a team to back you up. Let's get to the common definitions. Sale. complete disposition of stock or assets of an enterprise. All the M&A guys and your lawyer will tell you sell the stock and buy the assets. The bottom line here is you don't want the stock of another company generally because you're taking the liabilities associated with it, and that's any pending litigation that's been sitting out there or may someday come at you based on what the person you purchased had done. A spin-off is the disposition of a division or line of a business. Highly probable that most of the folks on this call someday will decide one service that they have they want to dispose of, and instead of just shutting it down, you might find that you can actually get some cash for it. An alliance is a business relationship where firms combine complementary strengths to both their benefits. You treat an alliance the same way you treat a sale. You have to have a document. I've seen a lot of small businesses going into, as I referenced before, revenue share agreements or referral agreements. And too often it's done on a handshake. My strong suggestion to you is that you have a document. They're very easy to find online. Basically have terms, have the audit rules, and also have specifically, all right, a regular ongoing review with the other person involved. That way you won't have any problems whatsoever. Why is this a hot subject right now? Well, the whole business cycle is accelerating. I think everybody probably online right now would agree with that. The globalization issue is happening. Requirements for scale. Most people are finding that they're competing against somebody bigger and they need to be bigger to compete against them. There's a high migration right now to specialization, and of course tech. You can always blame tech for everything. Now, what are you looking for? Well, most often these deals take place, especially in small business, to increase the speed to market, all right? And that is either expand into a new geography or whatever. And that's part of that sales distribution access you see in bullet 2. Access to new technology, defensive market share. If you've got a competitor, sometimes the best way to get rid of them is take them out, all right? And improve research. The last one is very important, especially today. I'm seeing a lot of this. The boomers are up there now. They're looking to dispose of their companies. Some of them haven't seeded talent in, and very often they're looking either to sell because they don't have a number 2 that can take on the company, and or they are looking to buy to purchase a number 2 who can take on the company. My number 1 rule: every day you wake up, you make a decision. You're either holding your stock or you're buying it. My way of saying, when you wake up in the morning, you've made a decision to run that day, you've kept your company. All right, you have to look at your company just the same way you look at buying or selling stock in the stock market. Now, those decisions, you wake up, you say, okay, I'm happy where I am, I'm going to stay where I am. Will the market let you? I'm going to fund growth through operations. Are your margins strong enough? You're going to merge or acquire. Are you prepared? That's what today's about. The same thing with alliance or selling parts of your business. The dozen reasons these deals fail. This may sound soft, but trust me, it is true. Culture is very, very important. It's absolutely critical. I'm going to give you some examples of transactions as I'm going along later that I've been in, and more often than not, everything crashes after a deal is struck because of a mismatch in culture and or priority and or management style. Sometimes these words get a little blended together. Failure to find a measurement and what the definition of success is an issue. Greed is important. This also contributes. When you get down to the lower stuff, you'll see that the regulatory government stuff, the valuation, and outside market really aren't the things that really impact mergers and acquisitions negatively. It's usually the individual principles of the 2 companies that are combining. All right. You have to look at M&A as a process. This is the process. Right? And what you see in that central column is the sequence of events that take place. You're going through a strategy process right now. You're defining what you want. You have a preliminary valuation. That is, you're trying to find the value of your company. You're starting to think about the type of transaction, a buy, sell, or a merger, a full merger. All right. You go through the courtship process. You go through the negotiation process. Then a term sheet is issued. A term sheet is nothing more than a preliminary buy-sell agreement, all right, that gives the basic parameters of the transaction. And then due diligence begins. Due diligence, by definition, is very similar to home inspection before purchase. And the buyer comes in and literally tears through the organization looking for every possible hair that exists. And the closing, and then the implementation of the plan, which is the whole reason you did the transaction anyway. While that's happening, and this is the distraction factor I had talked about before, you have to remember you're trying to run your company, you're managing the people who are incredibly distracted, you're funding the acquisition, you're trying to find the financing, right? And you're dealing with all the legal issues at the same time in parallel course. It literally is a three-ring circus. And there is where most individuals are ill prepared for the amount of time and energy that's required to do this. If there's been no plan, if there's no reason, I'm going to suggest that you never enter this. You have to understand what your position is and where you're trying to go with an acquisition. And you have to know what your other options are. M&A is only one option. Where do you begin to look for a partner? I'm going to move right to the next slide. Very interestingly, in small business, most often your partner is in your town or is known to you within the industry as a result of affiliation in an industry association. And most deals take place because somebody has either pupped, what I call pup is pick up the phone and call somebody and say, hey, I'm interested in selling or buying something. All right, and then the other person has probably initiated what I refer to as a whisper campaign. They've just let the market be aware that they are for sale or that they're receptive to a transaction. So your first two phone calls, by the way, are people in the industry that you know, and your lawyer and or your accountant or other business leaders in your community. As you move up in scale, all right, into the $50 million bracket, 10 million is usually the next bucket where you're into the venture capital like Marina, and or 50 million where you're into the publicly held company stuff. That's where intermediaries become more active and involved in the transaction. But chances are you know your buyer or your seller. Generally, again, this is another way of saying the same thing. $2 million, a couple of hurdle points for you, things I have seen. Right now, as an example, everybody's asking me about venture capital because there's so much of it available with the robust economy that we're experiencing. Generally, venture capitalists don't want to talk to you about either investing in your business or participating in an M&A arrangement with you, even finding or sourcing a partner for you, unless you've got an EBITDA of 1 million profit. All right, and or you're a $10 million firm, or, and this is the big or, you've got something really hot, a new technology, a new product, a new service that you don't have the capital to bring to market. Generally, in the small firms, which I believe is probably most of the folks on this call, on this webinar right now, you're going to find that it's an in-region transaction, and it's probably either a current competitor or somebody who's looking to enter a new business offering your product or service through their existing business. When I said before culture being the #1 contributor to failure, these are the reasons why. Quality sensitivity. Every entrepreneur has a different definition of quality. The next one is very, very important. I've seen a couple of deals crash because one partner could not follow disciplined rules of administration where the other person was almost anal or obsessed about it in terms of processes. As an example, if your company right now doesn't have documented processes, all right, and you merge with somebody who does, and all of a sudden your entire management team and your staff has to comply where before they had great latitude, that is the kind of thing that causes turnover and usually makes deals crash. Management style speaks for itself. And I would say urgency is another big one. Some folks have a very comfortable lifestyle with their business, and others are working 24/7. And when they get involved, they have an expectation that everybody's going to be the same way. And the last one is predatory thinking. By that I mean some folks are very, very aggressive in a competitive environment, and where another entrepreneur isn't. These are the kind of things that you should be looking for when you're beginning to talk to someone about doing a deal with them or aligning your companies together. All right. What's the definition of value? Here's where we're going to start talking about the money. Who are the experts? What's the process? And what are the building blocks of it? First of all, the definition of value. You've got to look at this in a couple ways. Emotional value versus economic value. Very often, entrepreneurs are extremely paternal about their, or maternal about their organizations. They take great pride in them, and they have a perception that it's worth a lot. All right, that may not be true when it's done on an economic value basis. Liquidation value versus ongoing concern value. I think there's a fun movie that was out years ago called Other People's Money, where you saw that a company was worth more if you shut it down, sold the assets, and specifically the real estate, as opposed to what it could actually earn over a 10-year cycle. And book value versus fair market value. The books may say one thing, but the market may be saying another. In the end, fair market value is the price which stock would change hands between a willing buyer and a willing seller when the buyer does not need to buy and the seller does not need to sell. That's really what your company is worth. Why do you go through a valuation process? Well, beyond M&A, there's a lot of reasons. Some people are involved in estate planning and the transition. They want to gift their company. Some of you may be evaluating an ESOP, employee program, where their employees are purchasing the company. You may want to be going to the bank to recapitalize. You just want to know what it's worth. And the last one is merger and acquisitions. In a recent presentation I gave, somebody brought up one that should be added to this list. Many of you probably or may have key man insurance, and one of the prerequisites of that insurance is that the company has a valuation on an annual basis. So the insurance company is assured that there's enough policy. Value changes based on the buyer. If it's strategic, the value goes up. If it's a passive investor, the value is usually lower. What do I mean by that? If you're going to merge two companies together and they're going to reduce all the administrative costs associated with it, and they're going to increase their market penetration, it's a great strategic deal. A passive investor is just somebody coming in who's just going to buy some stock for the passive investment of it. Usually the valuation then is lower. It all depends. This is a major factor in the valuation. The standards for valuation is all set by the government as usual. The IRS ruling 5960 still holds the keys as to what is the legitimate way of doing it. In case of ESOPs, the Department of Labor, and then of course the market and Wall Street. Who are the experts? Well, your CPA probably can give you a base valuation right now. It's probably not a bad thing to do. They're probably going to ask you for a couple shekels to do it, but it might be worth your money to find out if you haven't had a valuation of the company now. If anything else, the discipline of doing that is going to force you to get all your ducks in order in terms of paperwork and information, because if you ever decide to do a deal, you'll find yourself scurrying if you're not. The American Society of Appraisers also is a good resource for doing evaluation. If you're a privately held company, again, I assume that most of the folks on this webinar are, is a touch more complex. And again, as I said before, it varies greatly based on the purpose, the complexity, and lastly, the price. The purpose is more important. First of all, the way it's done is there's first a review of all the financials that I'm quite sure you're expecting, but then there's an audit of all the operations in the facilities. All right, and this is where your fixed asset lists are critical, and you have to be on top of your paper. all review strategies, all your marketing plans. And as I referenced before, is there documentation of processes? And also a small warning to all of you, most entrepreneurs are extremely lax of having their annual meetings and updating their book. I strongly suggest you do so. Otherwise, if you ever go to do a deal, you will be scurrying to back up meeting notes from prior annual meetings over probably a decade or more. Either using historical information, ratio analysis, fair market value adjustments, and then the economic reality of the day. And the methodology, I'm not going to go through these in detail, but you can do an adjusted net assets, a capitalization of earnings, a discounted cash flow, all terms you've probably heard before. The last one is the wild ass guess. I've seen many deals where there's no comps out there. There is no multiples or any record of them, and especially in the tech world right now, where new industries are being formed by the day. And sometimes you're just kind of just pulling it out. But in the end, it's a value of the value of your company is a multiple of a believable or projected EBITDA. That's earnings before interest and taxes, depreciation, and appreciation. Now, one of the things you may want to consider doing is having your accountant calculate your EBITDA for you, so you have a good idea where you're standing, because the minute you enter into a transaction, that's the first question that folks are going to be asking you. The variables, the benefit, again, is it strategic or not, the projection, the discount rate, and the time period. The discount rate is probably going to start increasing in our current environment today. How do you get better value for your company? Well, this is it. The top line counts. Profits. It is the number one thing that's going to give you greater value. You may think that buying a fixed asset, it will probably for an interim period of time reduce your value. The second thing is the management aspect. That is getting even more important because of that boomer transition cycle that I was sharing before that's taking place right now. People are buying management because they can't recruit management. The rest of the stuff I would consider softer. The brand, you're going to think you have a great brand and a great image. All of that stuff, in many cases, is you can't put a number to it. All right, so therefore it's going to be discounted in any valuation that's done of your company. In the end, you have to sit back and make sure that your financial statements truly reflect value. And again, a lot of entrepreneurs are somewhat creative in their accounting practices. If you ever go to do a transaction, you will pay dearly for that behavior. So if you're even thinking about this in the future, it is time to play fair. What are the business components? What are your real earnings capacities? And what is the plan? And is your business transferable? Because everybody always has an escape clause on every transaction. They want to know if they can get out. Maximizing your value, that's it, earnings. More profit you show, irrespective of what industry you're in, you're going to have a better valuation. All the other stuff becomes, I would say, much less important. In the end, the summary is it's complex, it's time consuming, and it can be expensive. At the minimum, you're going to be looking at multiple thousands of dollars just to get a basic valuation started. All right, let's talk about the process again. As I said before, you have to start thinking of a merger and acquisition activity as a process. And this is truly the sequence, and it is a three-ring circus, and this is the sequence that they all go through. Right, that is the strategy development, the courtship period, the negotiation, the term sheet, the due diligence, and the final implementation of the plan. A couple of months ago, I got involved in a transaction, and a person almost lost their business because they became so immersed in it they forgot to run their company, and their earnings started plummeting in the midst of the transaction. Some deals can take anywhere, well, it's impossible to say, some take place overnight, especially under crisis mode, but most transactions take a minimum of three months to a year, all right, to fulfill. And when you lose sight of your company is devaluing through the transaction, and therefore, in many cases, the term sheets and the contracts have a reset clause as to a new price. So be very, very careful that if you ever enter into this game, you do not become distracted. Inside the company, managing the people. You might find large corporations have a transaction team. At one time in a prior life, I was an M&A guy and on the M&A team. These are folks who have designated responsibilities for any time that there's a deal being made, they step into that role on a regular basis and they're prepared for it. And you measure the performance of the people. Put together your team. Now your team is going to also include your lawyer and your accountant. One of the questions you may want to ask your lawyer and your accountant, or next time you're in casual conversation, is how many transactions have they participated in? Very often small businesses' resources, and that is their legal and accounting resources, has not participated in the transaction. And they are probably not prepared, all right, to support you. So be prepared and ask the questions early because you may be looking for a new counsel. Designating communications with an individual. What this means is when you enter into a transaction, you should, with your new partner or whomever you're working with, have very, very formal rules in terms of who can communicate and when. All right, what are the standards? Is it email? Is it phone only? All right, what level of the organization? Set those rules early. A wrong phone call to a wrong person divulging some information through a due diligence process can crater a deal and actually undermine a company. The people part is very, very important. I wish I could ask publicly right now how many of you have ever been involved in a transaction, or that is your company has, and when it was announced, how did you feel? Please remember that if you ever get involved in a transaction, either on the buy or the sell part, the communication internally to your people is important because they're expecting change as a result of a transaction. And you should have the answers. Now that means that you're going to sit down really early in the process and establish the skill sets you're going to require for the new organization that you're going to be running with new products, new services, new geographies. Who's going to be staying? What are the roles and responsibilities? Who's going to be running what? Get that out there as fast as you possibly can early in the game. It will save you trouble. Turnover in the middle of a transaction can be death for a transaction. Remember what I said, many people are buying talent and management skills as opposed to fixed assets. Culture merging. Determine what the culture you want to be. All right. And this is also, even as a seller, if you're participating in the transaction and staying after the fact, and right now earnouts are extremely popular. What an earnout is very simply, you sell your company, all right, but you get a little bit of cash up front, and then you have a contract to work through it for a while in your company, all right, and that your payment, right, is adjusted either up or down based on the performance of your company after the transaction. So therefore, most sellers right now are really motivated to have their company perform well, all right? And if you're going to be in that mode, you want to participate in establishing what the new culture is and making sure that the systems are in place and the communication plans are in place to communicate a new culture wherever it is going to be new. Back to the process. Okay, now here we go. Now you're negotiating, all right? Understanding the numbers is the most important information I can give you in negotiation. Many entrepreneurs don't, and they get beaten badly by not understanding the implications of the numbers. The other thing I would suggest is that you want to be in mode. The worst thing you can do in a merger and acquisition is win too big. I enjoyed reading Donald Trump's Art of the Deal when it first came out, and found it somewhat upsetting that he, as an example, was touting some of his big wins. Big winning, people get even, all right, especially if they're going to be remaining in the transaction. Understand the numbers. Above all things, you'll make your negotiation much, much easier. Back to the process. The next thing that happens after the term sheet is issued is due diligence. Due diligence is, again, an overbearing exercise. Please try to visualize if you think an IRS audit is intense, this is multiples of that. They are going beyond your numbers, which is the very basic part of it. They're going through every operating procedure and method, all right, that you have. And sometimes the methods increase the valuation as opposed to decrease the valuation of the business, all right? If you go on my website and back into our blogs, I once published a blog. It was extremely popular at the time. I wrote this at the time of the Enron problem. It's called Ways to Cook the Books. And I suggest you may want to read it. It gives every possible scenario of ways that entrepreneurs have adjusted their books, all right, to look better on paper. Generally, that's all found out with good due diligence by an accountant. They're looking at the industry, they're looking at the organization, they're looking at the resources, they're looking at the financial. They're also looking specifically for any potential contingent liability that's out there. This is legal stuff, and any potential liability for back taxes. These are the kinds of things that you're going to have to be prepared to answer questions for if you ever got involved in a transaction. Back to the process. Structuring. How much are you buying or how much are you selling? Are you staying with it, or are you selling it, disposing of a piece of it? This is very, very, very important for you to know what your parameters, your earmuffs are before you begin discussions. I have been in negotiations where somebody expected to dispose of all the stock of the company. Find out after due diligence they got a partial offer. They were already into the transaction in terms of legal costs and other activity for over $20,000 to $50,000. And they were stunned, and they went through the transaction because they went that far. All right, make sure you know up front what you're how much you're willing to let go and not go, and get that set up front. Payment terms, sky's the limit. There's an unlimited potential of creativity in terms of deferred payments that, in this case, would have great tax benefits in today's environment. And I discussed already the subject of earnouts. Earnouts on small business right now are probably the #1 type of transaction that I'm seeing. How do you finance it? Well, this greatly depends. If you're thinking about buying, do you have the internal cash to support it? Now, please remember, internal cash is just enough for the down payment. All right, from there on, the combined cash flows of the merged entities should be able to cover a transaction. Bank financing. This is loosening up. When I gave this presentation like this a couple of years ago, I literally put a line right through that. It's loosening up. It's not beneficial, and they're going to put you through a tremendous amount of angst. But the capital is out there, and banks are lending. As I said, VCs, generally, if your company is not $10 million, or if you're not throwing $1 million in EBITDA, or you've got some super magic box, the VC guys are probably not going to want to talk to you, because they have to get to that scale to make the transaction worthwhile. And issuing more bonds and stock is not an option for small business. Back to the process. All right. Determine the power structure. I once worked for a guy. We did 9 deals together corporately, and he said it really came down to a couple of decisions. 1, who's going to run it? 2, where's it going to be located? And 3, what are we going to call it? All right. Who's running the company is something that the CEO, the final decision maker, is an imperative. I would caution all entrepreneurs about ever doing a deal where they've come into a partnership on a 50-50 basis. A 50-50 partnership generally is a formulation for lockup, in that no decision takes place until both partners are in agreement. It may sound comfortable, but very often it is a retarder of any growth strategies. Systems. Determine the interface in advance. Remember I said some companies have very high administrative sensitivity. Some have incredibly good systems. Don't underestimate the amount of time loss, loss of productivity, and problems with your current employees when they go into a merger environment and they're being forced to use somebody else's systems. All right, you could actually lose up to 10 to 20% productivity for the first 3 to 6 months post a transaction. All the processes have to be mapped out. This is a great discipline, and I'd encourage everybody to go through it. Most entrepreneurs don't have defined, written, mapped processes. I would use the merger and acquisition activity as an alibi to get it done. All right. It also makes the communication to your employees much, much easier. Obviously, bad communications contribute to hell. Last one I'm going to bring up is vendors. Very often they are the last people to hear the word. All right, you talk to your customers, everybody's worried about telling their customers they're going to lose their customers. They're telling the industry, if you know, whether they want to beat their chest and or get more deals. They're obviously telling their employees, and their transaction partner knows, but your vendors. I was involved in a recent transaction that went almost to the 5-yard line when it leaked out to one of the vendors, and the vendors basically said that they were going to change the contract because their contract, this was a major vendor, a significant part of their cost structure, and there was a change of control clause in their contract with the vendor, and they found out their price structure would grow by almost 15 to 20% the minute they changed hands. It killed the deal. Again, that entrepreneur lost all of his money. Make sure you're talking to your vendors. Key people retention. Be upfront and out front on this. Right now, with labor, with unemployment way it is, recruiting of talent is getting very, very difficult. It's getting very expensive. Be prepared. You may have to issue some retention bonuses. That is, make arrangements with some of your key personnel, because they're going to be unsettled during a transaction, that they will get a specific bonus if they are continue to be employed a year post the transaction. This is very important. And the last thing is that very often right now, benefits with the sensitivity of healthcare has taken on a whole new life in transactions, and people are starting to measure the quality that is, the employees are measuring the quality of the transaction by the benefit package they're either giving up or getting as a result of a new deal. Cost reduction. In small business, the ability to share and spread out administrative costs is usually up to 30% of the reason why you're doing something. Set the defined goals up front and make one person accountable for achieving them. They have a way of drifting away. Your revenue grows, but your costs continue to escalate, and you wonder why the deal never paid off. Managing the unexpected. This is my fun list. Most transactions have a term sheet at a time, and in the midst of the time, when you sign a merger agreement after the letter of intent is issued, you are off the market for some period of time. Usually it's 3 to 6 months, and behind you comes a higher bid. This is dangerous because then they do a rope-a-dope on the transaction. They slow it down for the potential of getting a higher bid. Be prepared. Employee dissatisfaction. All of a sudden, after the announcement, people start leaving, people get scared, and that kills deals. Financing problem, not usually. Usually the deal struck, the source of the funds has already been ascertained. Runaway due diligence. Remember I said about that house inspection? Once they're under the sheets and they find one thing, they keep digging further, and they keep digging further, and this goes on and on and on until that contract expires. If your company has had a decline in revenue during that period, either the deal runs away or they renegotiate the price. This one I have seen a lot of in the most recent, I'd say the last year. Dramatic change in financial condition. I've referenced that again. Running the business, being conscious of it as you're going through a transaction, making sure your profits remain up. Otherwise, you could run into a problem. Market conditions changing. Today's economic environment has pretty optimistic views going forward. This one I have not seen to be a big problem. If anything today, I hope I've given you a perspective of one, the sequence of things, and also the parallel activities that are going on. You're managing the people, you're finding the money, you're doing the deal, you're managing your company, all right, and you're looking to interact with your lawyers and your accountants and everybody else who's got their hand out through the transaction. The number one thing is, after a transaction is done, like any other project, is to step back and evaluate and put together a good list of lessons learned. Generally speaking, individuals who become involved in one transaction do another, all right? And it's a learning experience. The first one, you make all the mistakes that everybody does the first time they do something, all right? Make sure you've documented all the lessons learned and set your team together in terms of, remember I said the team, all right, that is your lawyer, your accountant, and your management team of who's taking accountability, and they all put down their written report relative to what they're going to do differently next time. Tom, do we have any questions?
No questions yet. I actually have a couple questions that came to mind for me. Paul, you mentioned term sheet. What are usually the contents of a typical or a term sheet? Just a kind of a general idea.
Well, it's no different than any other offer, and it can be the most simplistic document you've ever seen, or it can be the most complex document you've ever seen. Obviously, it's got the price. All right, it's based on valuation number. All right, and then it's got how it's going to be paid, whether it's going to be a lump sum transaction or multiples over some, and then if it's an earnout, what are the performance criteria that's going on. Mm-hmm. The term sheet also specifies the process and the timelines associated with the process before the entire transaction reopens again. So it's usually time and price.
Okay. The other, you mentioned liability, and I thought, and you did cover it in a later slide, but the HR liability thing really kind of jumped out at me because I think that's a modern, relatively recent, it's gotten a lot more attention recently than it did in prior years. So I know that, that seems to be one of the new hot buttons.
When you say HR liability, you're talking about
policy, having policies and procedures or HR issues lingering out there that, are going to jump up and bite you if you're not, as a newly in the game.
Yeah. Historically, small business has never had the administration, all right, to do everything perfectly or properly. I mean, that's pragmatic about it. Right now, with outsourced human resources capability, you can get policies and procedures and have pretty tight systems. There are new online process development programs, as I know you know of. All right, there are a lot of things that can help you, but in the end, that is one the contingent liabilities that are out there are the reason why. If you're on the buying side, you're going to buy the assets. Mm-hmm. If you're on the selling side, you're going to try to sell the stock.
Yeah, interesting. One of the other things that you mentioned was in terms of, you mentioned not having a 50-50 deal, and I just wanted to kind of clarify. You were talking primarily about management responsibility as opposed to necessarily it being ownership percentages. Is that correct, or am I missing that?
No, it's not correct. I'm being brutally candid here because you could say management responsibility, but in the end, if there are two 50-50 partners and one of them is the CEO and therefore has supposed power, the second partner can then just call the shareholder meeting and stop it. All right, so with the stock, the control of the stock is truly the decision-making power.
Okay. I've got a question here. Could you speak to the smaller company seeking to merge with a larger company for the purpose of growth and building a more powerful team, specifically when the companies are in different cities?
Yeah, great opportunity. A lot of it happening right now, just for, remember, speed to market and capitalization requirements to move to expand geographically, get very, very, very large. Great strategy. The number one issue there goes back to culture, is one that the larger company who you're aligning yourself with is going to have more sophisticated systems. It's going to have a different, very ingrained culture. There's going to be probably higher specialization. So just a small example of that. Let's say you're a small company of about 30 people or 20 people, whatever it is, and one person's wearing 4 hats. Well, they're going to be in the transaction process bombarded by a specialist of this and that company, a specialist of that, and a specialist of that. It can be overwhelming.
Sure.
Right? So those are the kinds of things that you run into when you start aligning yourself with somebody much bigger.
Okay. Does that answer that, Torlando? Great. Yep, that was good. Anybody else have any other questions or thoughts? Nathaniel, do you want to type it in? I'm not sure I can try to unmute you if you want to ask. So let's see if that works. Nathaniel, you want to ask your question?
Yeah, I just had a question. Do you have any I guess tips or advice if someone is looking, and if you're in an existing partnership and you want to buy out other members of that partnership, and how valuation plays into that?
Wow, great question. A lot of things come to mind, and so this going to be somewhat spontaneous and maybe not organized. First, that win-win comment I made, be very careful that you don't win too big on a buyout, especially if somebody's under duress. It will come back to haunt you later with other partners and also in the marketplace. It's a very small world. Second thing is, the first thing I would do is get a valuation paid for and get it commonly agreed to by everybody up front, an external third party doing it. All right, as opposed to a wild ass guess in terms of the numbers. It'll ground the entire conversation. It takes the emotions right out of it. Remember what I said about emotional value that people think they have. All right, and the last thing is that be prepared that, and this again is very pragmatic stuff. If you want some of the gory technical consulting stuff, I'd gladly write you. Just get a hold of me. But one thing I've found is very interesting is that there always is a perception by the person who is being bought out that they're irreplaceable, and therefore the company will go down the tank without them. Bizarre as it may seem, and therefore their expectation in terms of the money gets higher, and they want cash up front as opposed to a payment term program. So the first thing I'd do is I'd get a valuation and have it done by a third party. Makes it a lot easier.
Nathaniel, that kind of addressed that. All right, good, great. Any other closing questions? We did record this session. I'll probably, with Paul's approval, I'll publish that out after a couple of days and can send that out. But anybody else has any other questions, we'd be happy to take them.
And Tom, would the PowerPoint be available to them as well?
If you'd like, sure, Paul. Absolutely, we can do that.
Sure, absolutely, no problem.
Yeah, great. All right. Well, if there's no, don't see any more questions. Oh, wait a minute. Actually, we do have a final question. I came in a bit late, but caught that you'd written some books. Have you written about mergers and acquisitions?
I wrote a book called Skewed Entrepreneurial Strategies, where the M&A process that I just went through and the distraction factor is mentioned several times as examples. It wasn't specifically on M&A. It dealt more in a global sense of entrepreneurs, of the most frequent mistakes that entrepreneurs make. And one of the largest mistakes I'll bring up at the beginning is not knowing why they're doing what they're doing. What is the purpose? Are you building a company to sell? Are you creating a legacy company to transition to your children? Very often they don't stop. They start something and they don't stop and figure out what the long-range plan is, but they just keep going every day. And the way you would deal with things like M&A or not depends on that longer-term vision.
Right. Great. Any final questions before we wrap up? Well, I'd like to thank you, Paul, for being with us today. It was a great session. I know, as always, I learned a few things. And I'd like to thank everybody for being here, and look forward to seeing you at our next Success webinar. Have a great afternoon, everybody, and we'll look forward to talking to you soon.
Thanks, Tom.